Welcome to The Explainer. I'm putting on my expert investment analyst hat today, and together, we are going to put Wall Street's finest to the ultimate test. We're running XPEL stock through the absolute gauntlet of analyst stress tests. Now, let's dive right into this, because this company has a really fascinating financial profile, one that looks incredibly different depending on which investing legend's playbook you're looking at it through.
To find out if XPEL is truly a worthy investment, we'll be running its financials through 4 legendary valuation frameworks. First up, we've got a company snapshot and the Warren Buffett lens. Then we'll look at the Peter Lynch lens, followed by the Benjamin Graham lens. After that, we'll build a DCF valuation model, check out some alternative valuation models, and finally, bring it all together for our synthesis and final recommendation. Let's get started.
All right, Section 1, Snapshot and the Buffett Lens. We're talking economic moats and owner earnings.
So, currently trading right around $47.90 a share, with a market cap of about $1.3 billion, XPEL has carved out this highly specialized niche. They're a massive leader in automotive protective films and ceramic coatings. Basically, they protect expensive cars from the elements. They sell to dealerships, independent aftermarket shops, and directly to the original manufacturers. But, to a Buffett-style investor, the very first question is always, does it have a true economic moat? Well, based on their deeply embedded dealership networks and huge brand loyalty among car enthusiasts, yeah, they absolutely have a sticky ecosystem.
When we run XPEL against Buffett's core financial checklist, I gotta say, the company shines. They have incredibly consistent, positive net income. They boast a fantastic 18.52% return on equity, and just look at that debt-to-equity ratio, a remarkably low 0.05. That signals an efficient, self-sustaining business that isn't relying on heavy borrowing just to keep the lights on. It's exactly the kind of pristine balance sheet that the Oracle of Omaha loves. So the absolutely crucial point here is figuring out what this business actually yields for its owners. Let's walk through the math together. When we calculate Buffett's favorite metric, which is owner earnings, we take their recent trailing 12-month net income of $53.51 million. Then we add back the $13.88 million in depreciation and amortization and subtract out the $12.72 million in capital expenditures. What we're left with is a robust $54.67 million in true free cash generating power. Buffett would definitely admire the quality here. But, as we know, he demands a strict margin of safety on the price, which we'll evaluate in just a bit.
Moving on to Section 2, the Peter Lynch lens. Let's talk about finding growth at a reasonable price. The first step in Peter Lynch's playbook is categorization. Lynch would likely peg XPEL right on the border of a fast grower transitioning into a stalwart. And that's because of its wildly impressive multi-year expansion. Operating cash flow grew a massive 210% back in 2023, but we are seeing some slightly cooling, stabilizing recent free cash flows that have settled down to $58.37 million for the trailing 12 months. So it's really maturing into a reliable fixture.
We evaluate this sort of transition using the PEG ratio, which takes the price-to-earnings ratio and divides it by the growth rate. With a PE of 25.08 and assuming a stabilized historical growth rate of around 14%, we get a PEG ratio of roughly 1.79. Now for Lynch, a PEG of 1.0 is considered fair value. So at 1.79, XPEL is fully valued, and honestly, maybe even slightly overvalued relative to its pure growth rate. But you've got to balance that valuation risk against a rock-solid balance sheet with virtually zero net debt. That keeps it highly attractive as an underlying business.
All right, Section 3, the Benjamin Graham lens. Time for deep value and margin of safety.
Let's be real, Benjamin Graham is the strictest teacher in school. Running XPEL through his defensive investor checklist, it passes easily on adequate enterprise size, strong financial conviction, and earnings stability. But Graham is notoriously unforgiving. XPEL entirely fails his requirement for a dividend history, mainly because it doesn't pay one. It also fails his test for deep bargain multiples. His defensive criteria typically looks for a PE under 15 and a price-to-book under 1.5. XPEL's price-to-book? It's way up at 4.59.
To find Graham's exact valuation, we have to use his famous intrinsic value formula. We multiply his base multiplier of 22.5, which just represents a PE of 15, multiplied by a PB of 1.5, by XPEL's $1.94 earnings per share and its $10.43 book value per share. Then, we literally just take the square root of that entire product. Let's see what that spits out.
Ouch. This brutally strict formula yields a gram intrinsic value of just $21.34, meaning at today's $47.90 price tag, a deep value investor is finding absolutely zero margin of safety here. In fact, it's trading at more than double what Graham would consider a fair price. A traditional grand value investor would walk away from this one immediately and start looking for cheaper assets elsewhere.
Moving right along to Section 4, the DCF valuation model. Let's try forecasting some future cash flows.
We always start by establishing our baseline using XPEL's recent free cash flow history. As you can see, cash flow jumped significantly from about $31 million in fiscal year 2023 up to over $62 million in 2025 before settling at roughly $58.37 million for the trailing 12 months. So this $58 million mark is going to form the jumping-off point for our 5-year forecast.
Assuming a 10% weighted average cost of capital, which is just our discount rate reflecting the risk of the investment, and a pretty conservative 2% terminal growth rate into perpetuity, we ran a sensitivity table. By modeling steady but slowing growth over the next 5 years, our DCF generally anchors the stock's fair value right around the low to mid $40 range. Let's call it around $42. For us as analysts, this tells us that the current market price fully expects XPEL to consistently beat these conservative baseline estimates.
Section 5, Alternative Valuation Models. We need to look at relative multiples.
Evaluating XPEL's alternative multiples, like an enterprise value to EBITDA of 16.52 and a price to free cash flow of 22.62, shows us that the market is definitely pricing in a premium here. A PE of 25 demands continued operational excellence and solid high single to double-digit growth. Now, it's definitely worth noting that this is actually way down from its historical highs, where the PE was near 60 back in 2021. But make no mistake, it is still priced for a company that must execute well. This is certainly not a neglected value stock.
And finally, Section 6, Synthesis and Final Recommendation. It's time for the verdict on XPEL.
Blending all these insights together creates a really interesting picture. Graham absolutely hates it because the tangible book value doesn't support the price. Lynch likely holds it, recognizing a great balance sheet, but acknowledging the growth rate no longer vastly outpaces the PE multiple. Buffett admires the business quality, the 18% ROE, and the super low debt, but he definitely wants a cheaper price to get his margin of safety. And our DCF mathematical baseline suggests it's trading at a slight premium to its intrinsic value of roughly $42.
Ultimately, the numbers paint a picture of a fundamentally strong, low-debt, cash-generating machine that simply lacks a margin of safety today. It's a wonderful company at an okay price rather than a wonderful price, which leaves us with this final, provocative question. Are you a deep value investor waiting patiently for a bargain, or are you a growth investor willing to pay a premium today for quality that compounds tomorrow? The data is crystal clear, but the philosophy is entirely up to you. Thanks for joining me on this explainer, and keep stressing those numbers.